Hello and welcome everybody to the latest Killick webinar. Today we'll be taking a deep dive into a topic that is frequently requested in the Q&A from our other planning webinars, which is the topic of trusts. I have the pleasure of being joined on the panel today by three of my colleagues. I've got Sarah Hollowell, who's our Tax and Trustee Services Director, James Gordon, who's an Associate Planning Director, and Hannah Kirkpatrick, who's a Senior Trustee Services Advisor. Just a few housekeeping points before we get into the details today. There's a Q&A at the bottom, and we're hoping to answer any questions that people have got later on. Please do submit them as we work our way through the webinar. We will be covering a bit of material probably for the first 30 minutes, and then we've got time after that for about 15 to 20 minutes worth of Q&A. We've had a few questions submitted in advance, and we will try and get around to those as well. Beyond that, we are, in terms of where we sit from a trustee perspective, we are the professional trustees to a number of trusts. We provide advice relating to the establishment of trusts as part of various financial planning strategies, particularly with a focus on inheritance tax mitigation. We are able to administer trusts on behalf of clients, and fundamentally, as an investment manager, we are able to manage the assets that are held within those trusts as well. So we have a variety of experts on the panel today to provide a bit of insight on various different angles. We'll be talking through the pros and cons, the reasons for having them. But to begin with, we'll start with an introduction as to why someone may look to set a trust up in the first instance and what sort of trusts are available. So without further ado, at this point, I will jump over to my colleague, Hannah, and ask you, Hannah, to talk us through the various types of trusts that are available.
Hi everyone. So broadly, these are the types of trusts that I'm going to discuss kind of from start to finish, and what they do and why they might be applicable to certain circumstances. So we've got bare trusts, which are kind of the simplest form of trust that you can come up against, interest in possession, charitable trusts, and discretionary trusts. So start with bare trusts. So bare trusts, usually we see them for minor beneficiaries. So this is typically used potentially as gifting. So the settlor, who is the person that would transfer assets into the trust, transfers assets into the trust for the benefit of a single beneficiary who is a named beneficiary. And that beneficiary will be able to access the funds when they reach 18. And here there's a kind of basic structure of those types of trusts. So as I said, commonly used for intergenerational gifting. And the key part here is that it's typically gifting by grandparents, not parents. Gifting by parents into bare trusts can have adverse tax consequences, so we wouldn't usually recommend that. The beneficiary that's named, even if they're under the age of 18, will have an immediate right to both income and capital. So there's no discretionary nature of these types of trusts, so the beneficiary can't be changed. There's no limit on how much can be gifted. And that child, if you settle that money into a bare trust, will automatically inherit that money when they reach 18. So again, there's no discretion as to when they can reach that. The default position is they will reach that and be in control of those assets when they reach 18. So we have a worked example here. And David, there's a theme through all the worked examples that I'm going to discuss. David is getting himself into a bit of a pickle with a lot of scenarios throughout the worked examples. So this is the basic type of trust. David transfers £10,000 into a bare trust for the benefit of his 11-year-old grandchild. Obviously, Sarah's the grandchild. Sarah is 11. She can't take receipt of that money because she's a minor, but it's still deemed to be her money. So how does this work? So that 10,000 is gifted from David's estate or from David to Sarah. And whilst Sarah is under the age of 18, the trustees, who David would choose, can utilise that £10,000 for Sarah's benefit. So the default position is education, maintenance, or benefit, and they can use that. I mean, ultimately, they can't just go off and spend it on her behalf. They would be subject to kind of her questions when she reaches 18. That £10,000, that gift is taxed as if it belongs to Sarah. So it will fall outside of David's estate, provided he survives that 7-year period, which we'll discuss the tax kind of implications a bit later. Upon attaining 18, so we're on Sarah's 18th birthday, she's entitled to take that money outright. So it's the kind of bare form of trust, pardon the pun. So the next type of trust, which is slightly more complicated, is an interest in possession trust. So I'm going to refer to these throughout as a life interest trust. And the reason being is because that's what they're commonly referred to, but they are technically interest in possession trusts. So as it says in pink at the top, these allow the settlor, who's the person who transfers the assets, to transfer assets into a trust for the benefit of a specified beneficiary. So this can be for a period of the duration of their life, which is why sometimes it's referred to as a life interest trust, or it can be for a specified period. So sometimes you might say, a period of 5 years, for example. These types of trusts can be created during lifetime, but they're more commonly seen on death. So the settlor would choose the trustees. So they would say, my relative or my friend is the trustee, and the beneficiary might be a wife, or typically it's a spouse. So the settlor chooses how the trust is to be managed. And again, we'll discuss this in a bit more detail when we look at the worked example. But essentially, it gives the beneficiary an interest in those assets for that specified period, albeit life or for the period of 5 years or whatever the settlor decides. But it also ensures that the assets are protected. And again, I'll come on to this in a second. If these types of trusts are set up on death, typically these are for the benefit of the spouse, and if they are, then there's no adverse tax consequences for the settlor. So if we go on to the worked example of this, so this is a situation where these types of trust, interest in possession or life interest trusts, typically come about on death. That's when they're most commonly used. So David is back again. David has died. He leaves his assets into a life interest trust for the benefit of his wife, with the remainder parting to his 2 children from a previous relationship. So these types of trusts can be really beneficial for blended families, and also remarriage as well. So if you're, a little bit maybe older than your partner, you might want to protect your assets if you pass away first, and then from remarriage of your partner in future. So this works on the basis that David passes away, his estate, the assets that form part of his estate, pass into the trust for his wife's benefit during her lifetime. So she can live in the property rent-free. She essentially uses the property as if she owns the whole property. So she wouldn't just have to live in half of it or her half. She lives in the whole property. She can move house and downsize and release some of that equity in the property. But ultimately, the capital value that is there, that it forms part of that trust, is protected. So it means that she has full control over moving house, etc. But actually that the trust assets are preserved so that when she passes away, the trust assets can continue to pass to David's children from a previous relationship. So it means that you're making provision for your spouse during their lifetime, but on the death of your spouse, your assets continue to pass to your own beneficiaries. The reason this is beneficial is because a lot of time clients can leave assets outright to their spouse. The spouse then inherits and then can potentially change their will or remarry, and then another person that you're not anticipating kind of gets their hands on your money, which is not what you're expecting. So they're beneficial because for inheritance tax purposes, you would still benefit from spouse exemption. It's for tax purposes, it's as if it's passing outright to the spouse, but you have the added protection of the trust around the value of those assets. So these are probably the most common types of trust that we do, particularly in wills, because they have that additional protection.
Thank you, Hannah. You mentioned charitable trusts and discretionary trusts as well earlier on. Do you want to give us a bit of background on those two as well?
Yeah. So charitable trusts, so I mean, relatively straightforward. Essentially what they are is they're trusts that are for charitable purposes. So it allows the settlor, again, that's the person who transfers those funds into the trust, to have those funds in that trust for the benefit of specified charities or charitable purposes. So it could be that you might want to, have assets in that trust, and that those trust assets are used towards the environment and things, or animal welfare, those sorts of things. So these can be set up during lifetime or on death in the will. Again, the settlor chooses the trustees, so you would choose the trustees that you want to act for that trust. You would also choose the beneficiaries as well. So you might have a particular affiliation to certain charities, and you would choose whatever charities, or you could have a trust for charitable purposes. So you might say, well, actually, it's a broad spectrum. I want to make sure that this money is used for charity, but not necessarily name charities, and therefore give potential discretion to the trustees to allocate that money based on what your wishes are for example, animal welfare. The trustees have discretion to pay out funds to those beneficiaries, the charity beneficiaries. So again, David's back. David has died. He's left his assets into a charitable trust for the benefit of animal welfare charities and the protection of the environment. So his estate, when he passes away, this will be the net estate. So after payment of expenses, etc., leaves his estate into a charitable trust. So prior to his death, he has also created a letter of wishes directing the trustees that he's appointed as to how he wishes the trust to be distributed. So ultimately, he could say, well, actually, I want, every year £10,000 to be paid out to this charity, or he might say, well, actually, I'm happy for you to use your discretion and pay that out to any charity you think fit, or you can widen that or sort of make that slightly more limited. The trustees decide how the assets are to be distributed and when, typically in accordance with the letter of wishes. Gifts to charity obviously come with beneficial tax treatments as well. So inheritance tax, that it can be a good kind of tax mitigation method, but obviously dependent on circumstances. And then discretionary trusts. So discretionary trusts are kind of what they say on the tin. They're discretionary. So they allow the settler, again, the person who's transferring the money into the trust, to transfer assets into the trust for the benefit of discretionary beneficiaries. So typically what would happen, if I use the example of a will, you might put your assets into a discretionary trust during your in the will, and you would choose your trustees. The trustees would look after that money for the benefit of the beneficiaries you've chosen. The key distinction here is that the beneficiaries, whilst they are a potential beneficiary of that trust, they're not actually entitled to anything. So it's completely discretionary as to if and when they get any of that money. So the settler chooses how the trust is to be managed. Typically, this is in accordance with a letter of wishes, and that would usually be set up at the time the will is made, if we're talking about a will trust. And the settler would decide situations or circumstances in which they would be happy for funds to be paid out to those discretionary beneficiaries. It can increase flexibility because it may be the case. Often we see scenarios where potentially a beneficiary may be going through a divorce. Often it's not beneficial for that beneficiary to receive inheritance because it means that inheritance can potentially be used towards the divorce and can be considered for the financial settlement. So often discretionary trusts are used to ensure that the beneficiary is kind of provided for in some sense, but that money, because they're not entitled to it, it potentially can't be used towards the financial settlement in their divorce. So again, let's have a look at another, I think this is the final worked example. I know, please bear with me. So David, again, he's passed away. He has passed away with leaving his assets in a discretionary trust, and he's got his wife and children as discretionary beneficiaries. This isn't necessarily an example that would happen all the time, but it can happen dependent on circumstance. So a kind of good example of this as well is that divorce that I spoke about earlier. So David leaves his estate in a discretionary trust. On his death, he creates a letter of wishes to ensure that that the assets are distributed how he wants them to be, but ultimately this is the trust. The trustees have discretion as to how they are distributed, and how and when, if and when, ultimately how those assets are distributed.
Thank you, Hannah. It sounds like a discretionary trust could be used for other things as well. Perhaps would an example be that if you had a grandparent, say, who's alive, who wanted to put money for the benefit of their grandchildren, but only towards certain aspects, say education and property purchases, and potentially ensure that they're not able to access it from the age of 18. Is that another potential use case for these as well?
Yeah, so they're entirely flexible. So the thing to remember with discretionary trusts, you can't have it all. So you have the increased flexibility, but they do come with adverse tax consequences, which often when we're advising on these types of trusts, typically I would say that we have to weigh up the cost benefit analysis. So ultimately, if you're going to end up paying a lot more inheritance tax and the increased flexibility isn't necessarily required, then you have to weigh up whether the benefit you're getting from the trust is worth paying potentially additional inheritance tax. So yeah, there's a multitude of scenarios that we could come up with which are beneficial and which a discretionary trust works with. I mean, it may be the case that you've got a money grabbing daughter-in-law and you want to make sure that that money is protected, or another example would be that, as you said, it may be the case that you don't feel comfortable with children receiving large amounts of inheritance if they reach 18. You might want to set up a discretionary trust and then stipulate in your letter of wishes situations in which you'd be happy for the trustees to consider payment. So in cases of potentially 30th birthdays or significant birthdays, house purchases, weddings, those sorts of things. And it's completely flexible. So the letter of wishes, because it's not part of the will, it can be drafted in a more informal form, and it can cover a lot of different scenarios which we wouldn't necessarily put in the will because it wouldn't necessarily be binding in a legally binding document. So the world is your oyster when it comes to the letter of wishes within reason, but I have seen some wacky letters of wishes and definitely some obscure family circumstances which this trust would definitely help with.
I'm sure you have. Okay, well, thank you, Hannah. That's a good overview, I guess, of the types of trusts and how they work. I think what would be quite useful at this stage, perhaps, is if we get James, if you're happy to talk us through how a couple of them may be used in application for more advanced forms of financial planning and wealth structuring. So, James, why don't you talk us through some of the use cases that you run through with clients?
Of course. I mean, as Hannah's been discussing, there are different forms of trust: discretionary, interest, possession, and absolute trust. And again, these types of what we call wealth planning trusts can be set up on all those bases, but they do provide additional benefits for clients. One such trust, of course, is the discounted gift trust, DGT for short. Now, this and the loan trust, which is on the next slide, both provide quite useful wealth planning tools for clients, because essentially it allows settlers to settle capital into trusts while receiving a regular payment back from the trust, which is different to many forms of trust. So in the discounted gift trusts scenario, the discounted gift trust allows the settler to get that capital back on a regular basis, but the gift in itself is split in two. One element's called the discount and the other element's called the gift. The discount in itself provides a settler with an immediate discount against inheritance tax, which is incredibly useful, and it allows them to offset the amount that they are gifting into trust, so they can actually maximize the gift into trust. So normally with discretionary trusts, you are limited to your nil rate bands of 325,000 each. Essentially with a discounted gift trust, because there's a discount available, you can settle more into trust as a result, depending on the size of the discount. Now, how they work out the discount, it is essentially calculated on the settler's assumed life expectancy, the value of the fixed regular repayments, and the settler's health. And in using those different variables, they calculate a discount that would be offset against inheritance tax immediately. In terms of the gift element, then this is seen as either a potentially exempt transfer if they're settling this into an absolute trust, or a chargeable lifetime transfer if it's going into discretionary trust or an interest and possession trust. Once the capital is settled in the trust, the growth generated by the assets there is free from inheritance tax. The gift element will remain in one state for 7 years, but these trusts do fall into the relevant property regime, so periodic charging after 10 years and exit charges will apply. But they are very useful planning tools. They do add an extra layer of complexity and cost, but they have a real benefit to some clients.
Thank you, James. It doesn't sound like a simple setup, perhaps something that needs to be understood and discussed in terms of personal circumstances in detail before diving into a DGT?
Absolutely. I think they're very useful in certain scenarios, not just from an inheritance tax perspective, but actually from a drawdown strategy in retirement. They can help a lot. They can help clients refrain from accessing other assets such as pensions, which are already outside of one's estate. So they can actually dovetail quite nicely between different elements of planning.
Excellent. But why don't you talk to us about the next one you mentioned, which is a loan trust?
So with the loan trust, it is similar concept as the discounted gift trust, but rather than making a gift into trust, the settlor is actually loaning the money into trust. And so how that's set up essentially is the creation of a trust, then the completion of a loan agreement between the settlors and the trustees then invest the cash from the loan. But the settlor reserves the right to demand the repayment of the loan at any time. Now, where the difference is between a discounted gift trust and a loan trust is, one, there's no immediate discount. Two, the loan will remain within the estate, but is diminished each time it is repaid. And once the loan is fully repaid, the settlors can no longer benefit from the trust. The loan again is not viewed, as a potentially exempt transfer or a chargeable liability transfer, as there's no value attributed to it. So it's not actually seen as a gift because the settlor's making a loan to the trust in itself. As long as the settlor accesses the loan and just the loan by itself and doesn't benefit from the growth within the trust, then there's no gift with reservations concerns, which I'll talk about later on in the presentation. And should the settlor no longer need repayment of the loan, then at that time they can give up the right to the loan, which would then be deemed as a potentially exempt transfer or a chargeable lifetime transfer. So they can be quite flexible in terms of the loan element and what the settlors want to do with them, but very much like the discounted gift trust, it falls into the relevant property regimes. The periodic charge does apply, but there's no exit charges when it comes to loan repayments. Again, extra layer of complexity and cost to one's estate, but very useful planning tools for clients.
Indeed, I can see that forming a useful part of an inheritance tax planning strategy for many families. Within that, James, you've covered a number of reasons why clients may want to have trust, and Hannah as well beforehand. Perhaps this is a good segue. I mean, Sarah, for you to talk through, I guess, the reasons and the rationales for having a trust. Oh, actually, Hannah, why don't you cover the reasons for having a trust, and then Sarah, we'll move on to you in a minute for some of the implications of that.
So as we kind of discussed briefly, there are sort of various reasons and situations which can benefit from having trust. So one we've mentioned with regards to, particularly with the IIPs, which is the life interest trust, they can create a lot of asset protection and preservation for future generations. And going down that list on the left-hand side can also protect against divorce or remarriage. So typically remarriage would be applicable to the IIPs because it would mean that the assets in that trust would be used for the spouse's benefit during lifetime, but on death, the assets would continue to pass in accordance with your will and not outright to the spouse. Vulnerable beneficiaries, again, often we see clients come in with a beneficiary that they want to make provision for, but potentially that beneficiary isn't able to look after funds themselves. So sometimes they can set up, well, often they set up vulnerable persons trusts, which can come with kind of beneficial tax consequences as well, just to make sure that person is looked after during their lifetime and that they're not completely left out just because they might not be capable of dealing with funds. The protection against divorce relates more so to discretionary trusts because we might put assets into a discretionary trust to ensure that if there is a beneficiary going through a divorce, that money is kind of ring-fenced from those divorce proceedings. Intergenerational gifting, typically for grandparents gifting to grandchildren, and that's usually a bare trust which is set up. Estate and tax planning, as James just touched on, with discounted gift trusts and loan trusts, but other types of trusts as well, which we've covered, can also be beneficial for estate planning to make sure that your beneficiaries that you want essentially receive the money you're expecting them to, and the increased flexibility. Typically more so with the discretionary trust, but as I said, that does come with some potential adverse tax consequences dependent on the value of the trust. But you do have kind of complete flexibility over when and if that money is paid out. And you can stipulate very niche scenarios and situations in which you might be happy for money to be paid out.
Perfect, thank you, Hannah. That's a very useful summary of why you might want to trust. I guess it's probably a good point in order to create a balanced argument to move into the things to think about if you do create a trust. And we've talked about tax a number of times, so why don't we start with tax? And so, Sarah, I'll bring it over to you at this stage to talk us through, I guess, the big three taxes individuals like to talk about: inheritance tax, income tax, capital gains tax. So why don't you kick us off here and just talk us through what would be the tax implications under these regimes?
Okay, thanks, Will. Now, the taxation of trusts is hugely complex and can be quite difficult to understand, and there are lots and lots of areas that could be covered. And in the interest of time, I'll just do a whistle-stop tour of all the three main taxes, as Will mentions. And there can be tax consequences when a trust is created, which the settlor should be aware of. Then there are tax considerations during the lifetime of the trust, which the trustees will need to comply with, as well as tax considerations on some distributions, exit charges, and taxes when a trust comes to an end. So that sounds like a lot. Firstly, inheritance tax when the trust is created. So you might already be aware that gifts of any size made to individuals can be treated as a potentially exempt transfer or PET. And at the time of making those gifts, it's assumed that the person will survive for 7 years. So there's no tax at that time. However, the rules are entirely different for gifts or transfers into a trust. So a gift into a trust is a chargeable lifetime transfer, or CLT, which means it's immediately chargeable to inheritance tax. And although there might not be any physical tax to pay at the time of the gift needs to be assessed and the appropriate IHT forms prepared. Now, if the amount of the value gifted into the trust is within the available nil rate band, then there'll be no IHT to pay. And the amount of the nil rate band that's available will depend not just on what you're doing now, but whether any other gifts have been made in the last 7 years. So if the gift is in excess of the available nil rate band, then IHT will be payable at the lifetime rate, which is 20%. But if the settlor of the trust dies within 7 years, the gift will be brought back into their estate for the purposes of calculating the inheritance tax on death, where it will be recalculated at the rate of 40%. And I should mention here that where there's a charge to IHT on the creation of the trust, the tax can be paid either by the trust or by the settlor. And if it's paid by the settlor, then a grossing up calculation will be necessary to work out the amount that needs to be paid. And you can see the example in the slide there. Unfortunately, that's not it for inheritance tax, because depending on the type of trust, it might be assessable to inheritance tax on its 10-year anniversary, and then again every subsequent 10 years. But that sounds quite alarming, but the amount payable can be anything from 0 to 6%, and that calculation is based on the value of the assets in the trust on the day before the anniversary. There are some reliefs and exemptions that are available to reduce the value in certain circumstances. Now, that calculation is complex, and the trustees will need other information relating to previous transfers the settlor made, transfers from the trust, and details of any assets within the trust that are not relevant property. So exit charges should also be considered. Trustees might be responsible for inheritance tax exit charges when a trust comes to an end, or when a beneficiary becomes absolutely entitled to a share of the trust, or when assets are distributed to beneficiaries. And again, the amount payable could be up to 6%. And that calculation is very similar to the 10-year anniversary charge. And there are various factors that need to be considered when you're working out the amount of tax due. Income tax, the next big one. Trustees are responsible for reporting income and gains to HMRC on an annual basis, and for making sure the taxes are paid by the deadline. And that would usually be the 31st of January, following the year in which the income or gains arose. But if the trust sells residential property, a CGT on property return would need to be submitted, and the tax paid within 60 days in the same way that you have to for an individual. So I think some trustees aren't aware of this. Different rates of income tax apply to different types of trust, but broadly speaking, interest in possession trusts or life interest trusts will pay tax on dividend income at 8.75% and all other income at 20%, whereas the dividend rate on tax for accumulation or discretionary trusts is 39.5 39.35%, and all other income is taxable at 45%. And I've got here on the slide a few points to note on income tax, because it's such a big topic, but these are some bullet points really. From the 6th of April 24, where a trust has income of less than £500, that trust wouldn't normally be expected to pay any income tax. But where a settler has created multiple trusts, that £500 would be split. And if the trust's income is over that £500, then income tax is due on the full amount. Where there's a settler interested trust, and a settler interested trust is where the person who created the trust or their spouse or civil partner can benefit in any way, they'd normally be responsible for the trust's income tax and CGT themselves. And Hannah's already touched a little bit on the tax for bare trusts having adverse tax consequences for parents. Bare trusts are usually taxed on the child for whom the trust was created, because a bare trust is really an outright gift that's just being held on behalf of a child who isn't old enough to look after the funds themselves. But where it's created by a parent and the income exceeds £100 in a year, the parent is responsible for the income tax, and that's really a way of preventing parents from putting all of their money into their children's names. So the next point is an interesting one and quite complex. So this is where trustees of a discretionary trust or their tax agents should keep a record of any income that's paid by the trust, and that's known as the tax pool. Then where trustees make a payment of income to a beneficiary in a discretionary trust, this is reportable on the tax return, but it's grossed up, and it's the grossed up amount that's subject to income tax at the rate applicable to trusts. So a grossed up payment of £5,500 to a beneficiary would actually result in tax of £4,500. But the amount that the trustees have to physically pay would be reduced by any balance that's in the trust's tax pool. That's why it's really important that good records are kept there. And trustees will often try to make sure there's enough money in the tax pool to cover the tax credit on any potential income distributions to a beneficiary. And then once the beneficiary has received that distribution, they can very often reclaim some of the tax back from HMRC on the difference between their marginal rate and the 45% that's actually being suffered. And one other note is that occasionally the trustees might mandate income to the beneficiary of a life interest trust. And where that happens, the beneficiary needs to include the income on their own tax return as their income rather than as trust income.
Quite a bit to remember in there. So certainly enough to keep you and your team busy. What about the capital gains tax side of things?
Okay, capital gains tax is a little bit easier. Firstly, when a settler creates a trust, there's a deemed disposal for CGT purposes if they transfer assets such as a property or some shares into the trust. So although they don't actually receive any money, they're treated in the same way as if they sold those assets at market value. And CGT would then be charged on the settler at their marginal rate. But it is possible in most cases for a holdover relief claim to be made. That's where there's an immediate charge to IHT, even if no IHT is actually payable. And the result of making that sort of claim is that the trust would effectively be taking on the assets at the original cost, so they meet the capital gains if they subsequently sell or transfer the assets. It's similar when an asset leaves a trust, say when a beneficiary comes of age, they're treated as deemed disposals for capital gains tax purposes. And again, holdover relief might be available if there's an immediate charge to IHT. And this can be particularly beneficial if you've got a beneficiary who's then able to use their own CGT exemption limit, because the trust's exemption limit is much, much smaller. And there are instances where holdover relief can't be used, such as when the trust is settler interested or where a beneficiary is non-UK resident. And then there's actual disposals made within the trust during its lifetime. These reported on the trust's annual tax return, with CGT being paid at applicable rate by the trustees. So CGT is much more straightforward and simple than income tax and IHT.
Seems it. I guess from looking at this, it seems like tax paid by trusts usually seems to be at the higher of the rates that are accessible to an individual. Is that generally what you would say?
Well, it depends on the type of trust. For most discretionary trusts, then they're going to be paying tax at 45%. And so where there is a discretionary payment of income to a beneficiary, they're usually, if they're not a 45% taxpayer, they're usually going to be able to claim some tax back. But for most interest in possession trusts, they're going to be paying tax at 20%. And so in the hands of the beneficiary, they might be liable for some more tax on that trust income.
Good to know. Beyond the sort of taxation side of things, what else should individuals be aware of when they are setting up or establishing a trust, or even thinking about establishing a trust, when it comes to the revenue that's generated, any gains that might be generated, income, that sort of side of things?
I think one of the important things to know is if you've got a trustee taking things on, is firstly being aware of their responsibilities. And one of the big things that we see people getting in a muddle with is getting income and capital, not keeping income and capital separate. And it's really important to do so. So, for example, with a life interest trust, as Hannah mentions, the lifetime beneficiary has a right to income from the trust, and someone else will benefit from the capital when they die. And the trustees have got an equal responsibility towards both sets of beneficiaries. So they need to make sure that one isn't disadvantaged. So, for example, if there's a CGT liability that arises in a trust and there's no available liquidity on the capital ledger, income shouldn't be used to meet the tax liability unless there's agreement to do so, because otherwise that income beneficiary might suffer a shortfall in regular income payments. And trustees can unwittingly create tax liabilities if they accidentally pay out income instead of capital, or the other way around. And another one of the things that crops up all the time is property and trusts. People very often ask us about putting their own home or a second home or maybe a rental property into trust. And there are some very important points to consider beforehand. So firstly, the trustees are the ones who are responsible for insuring the property. And if there are no assets in the trust other than the property, how will the insurance be paid? Likewise, any other costs or fees for professional services that might need to be met. Also, if rental income is received, then that would result in a tax liability. So again, enough money needs to be put aside to meet the tax bill. Problems often arise because of a lack of liquidity within a trust that contains properties, or multiple properties in particular. And if the settlor has to introduce funds to meet those costs, it can result in a multitude of problems, one of them being the tax consequences. And saying that, there are lots of instances where property in a trust can work very well. And the most common scenario is one that Hannah mentioned earlier, where a life interest has been left to a spouse in a will, because that gives the spouse the right to live in that property and to enjoy the income from any assets in the trust till they die.
Certainly plenty to think about there, and I can understand that the complexity probably keeps you and your team very busy, Sarah, in helping clients to manage those. James, over to you. I guess one of the points we wanted to cover off today was, if you are thinking about using a trust for inheritance tax planning, what are the common pitfalls that individuals might fall for in terms of managing this as part of a broader plan?
Of course, I think the two that spring to mind, of course, are gifts with reservation and deprivation of the estate. Gifts with reservation is quite an important consideration, really, and essentially, should an individual, donor, settlor, make a gift in their lifetime to a beneficiary and still have the ability to enjoy the benefit from the assets they have gifted, then it would be deemed as a gift with reservation. So as a result of this, HMRC would say, well, actually, you're still benefiting from this gift. It remains part of their estate for inheritance tax purposes. So if I use an example, let's use David, as Hannah was using David earlier. David decided to gift his holiday home, or a couple decides to gift a holiday home to their children, but continue to enjoy regular use of the holidays and having holidays at the cottage or the holiday home without paying rent, then this would be deemed to be a clear gift with reservations and essentially would fall back within their estates. But should they have been using the holiday cottage and having holidays there and paying a full market rent for its use, then the property wouldn't fall foul, or the gift wouldn't fall foul of the gift of reservations rules, because they've been paying a market rent for its use. The other element to always consider comes around care and covering care costs. So deprivation of one's assets, or deprivation of the estate, is seen essentially as the knowingly and sometimes quite quickly reduction of your assets and finances to avoid paying for care. Now, the council will look at this in various ways, and the local authorities will as well, and they may construe this to be gifting large sums of capital to one's family, transferring the ownership of property, or an extravagant spending spree, such as buying a yacht in the Mediterranean and using it as much as possible. But that would be frowned upon in some respect, and they would take that into consideration. Now, of course, it would be unfair for them to take into consideration certain gifts that have been made. So they do look at things like the length of time since the gift was made, the needs of the person the gift was made to, and actually the intentions behind the gift. So, they will be quite logical in the way they approach this, but if one does reduce one's estate quickly, then essentially they will be looking into that, and it could be deemed a deprivation of assets.
Thank you, James. Important warnings, I guess, for anyone who is thinking about putting everything into a trust and not worrying about it afterwards. I'm cognizant of time. Just for everyone else's benefit, we've only got sort of one or two more bits we wanted to cover, and then we'll move into the Q&A. And I can see there's quite a few questions already there, so we will make sure we have time to answer as many as we can. I guess one of the final points we probably need to cover off, we've touched on the role of a trustee in various guises throughout this presentation, but Hannah, would you be able to talk us through really what the responsibilities are for a trustee and what they need to be thinking about as part of this process?
Yeah, so I mean, the initial process is the trustee registration service. So trustees should register their trusts with HMRC. There are two kind of dates to work from in relation to the creation of the trust. So if the trust was created on or before the 6th of April 2021, then there's a slightly different rule to trusts which are created after that date. So if it's a newer trust, which would be after the 5th of April 2021, then the trust must be registered within 90 days of the trust becoming liable to UK tax. So that's kind of the key part of the trustee registration. If the trust isn't registered, then HMRC does have powers to enforce penalties against the trust, and that ultimately, we want to avoid that as much as possible. So if there are any issues with registration of trust, then obviously we seek advice as to how to do that, but it's definitely a key duty that the trustees have. There are kind of more broader duties which we have, which I mean, as it says on the tin, keeping accurate, up-to-date records, decision-making about the distribution of assets, potentially if it's a discretionary trust, managing the assets and working out where the assets are going to be put to kind of potentially make the most benefit to the trust, investment duties, which we're going to discuss slightly in a second, protecting the interests of the beneficiaries, accounting, so keeping accounts of all the trusts, distributing to beneficiaries, and trustees should be trusted, and therefore they should act with honesty, integrity, and objectivity as well.
So not a small task for anyone who's asked to be a trustee on behalf of another individual, which I can understand the need for professional trustees in that regard, to take away some of that burden from the individual. You touched on investment duties and asset management there, and I think as a wealth manager, it would be remiss of us not to dive into that in just a little bit of detail. Not long. I think we've got one slide on this, haven't we, James, which we're just going to talk us through in terms of what is the role and responsibility and how do people look after trusts from an investment perspective?
Of course. So investment principles and structures, I think both are quite important elements when one's looking at investing the capital in trust, but modern trusts should allow for an extensive range of investment powers into a wide range of tax wrappers, and both those elements are very important because when one's investing, you also want to try and make sure that you're mitigating the tax where possible within the trust itself. Yet the trustees do have a duty of care and should act in the best interest of all classes of beneficiaries when making investment decisions. And the trustees are generally expected to take advice and consider diversification. So that's an important consideration when the trustees are making investment decisions. Trustees must also consider and choose the appropriate tax wrapper for the trusts. When making investment decisions, the trustees must take into account the goals of the trust and take into consideration what is prudent. And of course, the types of investments and assets that can be held within the trust can be anything from unit trusts, direct equities, property. So they're quite flexible in terms of what they can invest in. I think outside of all of this, there are other considerations that should be considered when investing capital and trustees making investment decisions. And of course, that should be things like the size of the fund, the taxation of the investments themselves, the tax position of the trustees and the beneficiaries, of course, tax reporting obligations as well, and the risk profile of the fund within the trust. So they are all quite important considerations. And really, when it comes to the taxation of the assets within the trust, that comes down to the structuring element as well, and how that can help from a tax perspective. So, as I said, both the elements, the investment side and investing capital, has to go hand in hand with the actual structure used, because there are some very beneficial structures that can be utilized to help with the reporting and the taxation of the fund itself.
Thank you, James. I think it's an important note there that for trustees that this is effectively not their money, but in fact the money of the beneficiaries, and needs to be managed in the most effective way for
Absolutely.
them. Brilliant. Well, this has been, as you can tell, trusts are quite a detailed topic, and this has been a little bit of a whistle-stop tour in terms of covering a variety of elements in a little bit of detail. We do want to now move on to a Q&A section. So I'm going to stop sharing the presentation, and hopefully we should now be back up on screen for everyone. Before we get into that, I just wanted to let everyone know that obviously we could try and answer as many questions as we can now. We may not get round to all of them. There are some questions that we've had that are a little bit specific and may need to involve a more direct conversation with one of our advisors. We can provide general answers today on trusts and some of the topics discussed, but where it comes to individual circumstances, we wouldn't be able to comment on the appropriateness of a solution without further identifying the need within that, and perhaps having a bit more background as to some of the scenario. So hopefully we're going to put a question up on screen now for everyone, which is that if you would like us to get in contact with you, if you would like to speak to one of our advisors about a trust or about how a trust may be beneficial in the circumstances, or even just to get a broader understanding of the content that we've discussed today, you've got an option here to click yes or no if you just want someone to follow up with you directly. We've got teams of advisors here at the business who'd be more than happy to contact anyone directly. Obviously, we won't contact anyone who doesn't wish to be contacted. So I'll leave this up on screen just for a second whilst I rearrange my own screen so that I've got the Q&A in front of me, so that we can begin getting into a few questions. We had a few submitted ahead of time. In fact, we're going to start with one that was submitted a little bit ahead of time. And at this stage, I'm going to pass that over to Sarah. And Sarah, one for you, I think, here, which is we've had an email in from an individual who has a number of friends who have trusts, within which they shelter a broad variety of assets, including their own home, their own main residence, from IHT, as well as other taxes. This individual has heard that may not be an effective solution for the purpose of mitigating inheritance tax, and wants to understand, if set up properly, do trusts around property, particularly main residence, work, and can you give any typical examples of the type of trust that would need to be used and the things that need to be thought about in order to actually get that to work?
Okay, thanks, Will. I think we've touched on a lot of those points already. So we've discussed some potential pitfalls of having property in trusts, like potential lack of liquidity to meet insurance and other costs. James mentioned gifts with reservation of benefit, potential deprivation of assets. Other than that, if the trustees are aware of the tax consequences, then trust structures could work well in that type of scenario to protect assets. But another point to consider that I didn't mention when we were talking about IHT, because we were only doing a bit of a whistle-stop tour, is that by putting property into trust, you could potentially lose out on the residence nil rate band. Not in all cases, but quite often you would lose out on that. And I think that there can always be changes to the tax system, so you need to keep an eye on things to make sure that you're up to date, and that anything that you've got in your mind that you might do, probably get some advice, particularly if it is about putting stuff in trust. And obviously there are tax consequences, but as well as protecting the assets, obviously this 7-year rule, if you do make a lifetime gift, there's an immediate charge to inheritance tax. You talk about protection against IHT. There's an immediate charge to inheritance tax if the gift is worth more than the available nil rate band, but the lifetime rate is of course lower than the death rate.
Perfect. Thank you, Sarah. We'll try and rattle through some of these early questions, and some of them may be a little bit quicker to answer than others. So, Hannah, this is one for you relating to one of your early examples. On the interest in possession example, would this still work if the spouse is a cohabitee but not married to the settlor?
Yeah, so interest in possession can be beneficial for a lot of different circumstances, so it can still apply to a cohabitee. The thing to consider here is that inheritance tax implications might be different. So usually with an interest in possession trust, if you're leaving assets in that trust for a spouse, you wouldn't pay inheritance tax straight away because you'd have spouse exemption, whereas leaving assets to a cohabitee, potentially you wouldn't get that inheritance tax benefit, but you still would have the protection of the trust assets. So you still have the ring fence around those assets to make sure that the cohabitee is provided for, and then on the death of the cohabitee, those assets pass to your relevant beneficiaries.
Perfect. So the tax treatment may change, but the overall structuring is going to work.
Exactly.
We've had a lot of questions. I'm just going to cover this one off. We've had a lot of questions regarding the slides, whether they will be made available afterwards. They will be made available afterwards. There will be a follow-up email to this presentation, to this webinar, and we will make sure that the content is available for those who wish to refer back to it. We're aware that we've covered quite a lot of information in quite a lot of depth, and people may want to get back to it at a later date, or even discuss it with others in the family or friends, etc. Perhaps a quick one for you, Sarah, just in terms of our capabilities here as a firm. Can we set up and administer Scottish trusts? And I think I actually missed a disclosure that I should have made at the beginning of this, which is that we were in fact focused on UK trusts, and that we are unable to sort of give advice relating to international trusts, as we're sort of experts in UK legislation, but specifically Scottish trusts. Sarah, is this something that the team can help with?
Unfortunately, we are specifically only able to deal with trusts in England and Wales.
Thank you very much. So unfortunately not for the individual who's asked that question. We've covered this in a bit of detail, but perhaps it's good to sort of really get a straight answer on it. One for you, James. If an individual is passing assets into a bare trust or a discretionary trust, does the 7-year rule still apply, and does the transfer trigger capital gains tax?
So transfers into trust any gift essentially will trigger capital gains tax. So yes, and from an inheritance tax perspective, it's the 7-year rule that applies for gifts into bare trusts and gifts into discretionary trusts.
Perfect. So if someone is gifting in any form of asset that is invested, property, stocks and shares, bonds, etc., that is going to be a CGT event potentially.
Yes, potentially.
So treat it almost as any other form of, if it's going from a person to the trust, it's effectively got to be sold and bought back, although that transaction is never actually taking place, the tax implications remain the same.
Yeah.
Brilliant. Thank you very much. One for you, Sarah. I guess we sort of skipped over costs a little bit in here, but we've had a question. What are the charges for setting up trusts? Do they vary for different types, for example?
It can vary. Obviously, at Killick, we are professional trustees, so we can make a charge for the ongoing trusteeship and for creating a trust. And we have our own rate card. If anybody wanted it as a follow-up, then we could send that to them. Alternatively, people might want to speak to a law firm who they might already have a relationship with. So the fees do vary, and there are usually costs of setting up and ongoing trusteeship. And it's usually based on perhaps the value of the assets that are in the trust.
Brilliant. Thank you very much. Hannah, one question from earlier on about your life interest trusts. The question is, how are they wound up? And is it possible for the trustees to terminate the trust and pay out the assets to the beneficiaries ahead of the end events?
Yeah, so it depends on how the trust is drafted. Usually, if we were going to draft a life interest trust, we would make sure that there's provision in there that those funds can be paid out, and they're usually called overriding powers of appointment, which means that the trustees have powers to pay out capital to either it can be the life tenant who would potentially be the spouse. It can also be other beneficiaries as well. So there is flexibility that way, depending on the drafting of the trust specifically. And they can be wound up. So ultimately, it may be the case that during the lifetime of the spouse, if we're using that as an example, it may be decided between the trustees and the beneficiary that we no longer need the trust and we can wind it up. So what would happen is the money would be paid out, trust would be wound up, and any relevant taxes or filings with HMRC would be dealt with. The other option would be that the trust period would just run until potentially the death of the spouse, and then the trust is wound up that way. So it can either be done it could be finished during the period of the trust, i.e. if it's agreed, or wait until the death of the life tenant, and then it's paid out after that.
Thank you very much. James, I've got a couple of questions here that I'll probably fire over to you. Very quick one to begin with. You mentioned that SIPs are exempt from inheritance tax. Can we get confirmation for one of our?
Yes, of course. SIPs normally written under sort of like in the same way as a discretionary trust in itself, and so they are seen as exempt from inheritance tax.
Brilliant, thank you. And then a second question, which I'll pass to you, and then I've got some questions for Hannah and Sarah. An individual would like to put £1,000 into a stocks and shares ISA for a child. The gains are to be untouched, compounded, and the final sum paid out at the age of 60. Which trust would be suitable? Now, I've got my own view on this, James, but I'll let you answer it first, and then I'll possibly give an alternative option for the individual who's asked the question.
That's a good question. I think there's a few options naturally, and in terms of, I think the underlying point there is actually what structure should be used within the trust. If we do go down a trust route, of course, there's also ISAs and things like junior ISAs, I could say as well, which have their benefits. But I think in terms of, it depends on the objectives of the trust as well. So we're thinking about what are the objectives, what are the flexibilities one wants. A bare trust a child can access at 18. So if the objective is to get to 60, did you say?
60, yeah.
60, it sounds like a discretionary trust is probably best placed.
Yeah, I think that makes sense. Although I think linking back to the point that I've just asked you about in your previous point around pensions being written on trust law, if you wanted to put £1,000 aside for a child and not have them access it until the age of 60, I would consider putting the money into a junior SIP, which you can also do. Benefit from a little bit of tax relief. You get the basic rate tax relief for a non-earner pension contribution, let it roll up, and of course they were unable to access that until they reach the minimum pension age, which is, by the time the child reaches 60, will be at least 57. And so while you may not get the age 60 precisely, you would be able to put it into a pension and let that roll up and benefit from that gross roll up as well. Thank you, James. We talked about discretionary trusts. So probably Hannah, one for you. Is the wording in the letter of wishes legally binding on the trustees?
It's not. So the letter of wishes increases the flexibility because it's not legally binding, and there aren't a lot of legal documents, you'll notice they are specifically worded because otherwise they're not legally binding. So the reason you have the flexibility in the letter of wishes and it can be drafted in any form is because they aren't. But the kind of key bit of advice there is in relation to the trustees. One, make sure that you trust them, but the other option is that you can potentially appoint professional trustees who ultimately have no incentive not to follow the wishes in the letter of wishes. So if you are concerned about the wishes not being followed because it's not binding, then that's definitely a route to explore, because ultimately there's no reason why a professional trustee wouldn't follow that letter of wishes.
Brilliant, thank you very much. We're pushing on for 6 o'clock, but let's just do a couple more questions. Sarah, one for you. How should bare trusts be? In fact, I'm going to double up on this. One for you. How should bare trusts be documented? Letters, detailed agreements, oral. What are people looking for in order to confirm that it is in fact a bare trust?
Definitely something in writing. It doesn't have to be a formal deed, but I would suggest that you either get it written up as a deed or you write it in the same sort of way as a deed would be written, so that it's very clear that the intention is that it's a bare trust and an outright gift. Because otherwise, if there's any ambiguity about your intention, that money could end up being counted in your estate when you die. So as long as it's very, very clear that you're making a gift to the child, it doesn't have the same restrictions as an actual trust where you need to have a formal deed. But I would recommend something that's a deed or written in the same way as a deed.
Perfect. Thank you very much. And then what are the costs of maintaining a trust on an ongoing basis?
It's going to depend on the complexity of the trust, really. Obviously, if you've got a trust and it's got and you put money in it that then needs to be invested, then there are going to be costs for delegating the responsibility of the investments to an investment manager who's going to manage the assets on a discretionary basis. There's going to be those fees. You might have fees for paying a professional trustee. If it's a lay trustee who's looking after some money and they've passed on the responsibility of the investments, then there may not be any other costs. Obviously, if the assets in the trust are properties, there could be all sorts of costs. You might have property managers involved, insurance costs. So because there are so many different types of trusts, it depends on the size and the assets that are within it and how many professionals you actually need to have involved with the day-to-day management of that trust.
Brilliant. Thank you very much. One last question, because it's caught my eye, and this is going to be personally indulgent on this one because we've had a lot of conversations with clients over the last year or so, particularly on the subject of school fees. It's a hot topic at the moment, and we will be producing more content over the coming 6 to 12 months, specifically focusing on this topic for clients as we look ahead to the general election. Conversation about potentially adding that to school fees, the implications of that on families who are already in the system, those who wanted to pay for that for children or grandchildren moving forward. So James or Hannah, I don't mind which one of you two wants to pick this one up, but perhaps one of you would like to answer the question: why would a grandparent use a bare trust or a discretionary trust to help with school fees for a grandchild instead of simply paying the school fees directly? And open to your views on what the most appropriate method may be, and if you say it depends, then it depends, but just some ideas on that from either of you, please.
I think actually thinking about it, the bare trust and discretionary trust, it depends on how one's looking at it. Are you happy just to pay on an annual basis and pay it from one's own account, or would you like to set up some sort of fund? Because essentially, if you're putting money into trust to start with, you're starting that 7-year clock already, rather than making gifts for paying for the educational costs, which would essentially be a 7-year clock each time the gift is made to pay for the costs. So my view would be essentially there is advantages of using trust because you're starting that 7-year clock quicker than making individual gifts year by year. I don't know if Hannah would agree with that or not.
Yeah, so as James has said, each time you pay their school fees, that's a potentially exempt transfer, and that 7-year clock begins. With the bare trust, which is typically the one that would be used for this purpose, you could potentially gift money into the trust for the benefit of that minor, and you could give a lump sum, and that money can be used towards school fees. So it may be the case that you gift a lump sum in to cover school fees for say 5 years, and from your perspective it's a potentially exempt transfer. The 7-year clock starts with that lump sum, but then that money can be used towards school fees. So it may be more beneficial to use the bare trust rather than pay every year or every term, because otherwise you're going to have 4 7-year clocks starting every year potentially, as opposed to just having this one if you create the bare trust with the bulk amount, if it's kind of doable for you from a financial perspective.
Can I just add a point there that I just thought of as well? Another reason for where a trust might be an advantage is if you were to make regular payments direct to the school and you were then to subsequently lose capacity, obviously everybody hopes that they never will. if you've got a power of attorney in place, your attorneys probably wouldn't be able to continue making those payments to the school because they're not best interests. That's a discussion probably for a different webinar, but I just thought I'd mention that in there as well.
No, it's a very good point. Thank you, Sarah. So it's about the certainty of being able to make those payments, the certainty of the potential inheritance tax implications early on, versus, you know, some added flexibility, potentially some preferential tax treatment if you're doing it regularly out of income. So I think going back to our earlier point, a lot of these circumstances are nuanced and depending on everyone's individual circumstances. So happy to discuss that with anyone who would like to pick that up. We are sort of over time and we've overrun this evening, but we've got a lot of questions that remain unanswered. And for that, all I can promise is that we will attempt to reach out to everyone who submitted a question with a written response. One of our advisors will be in contact with you directly to try and answer that question for you, or arrange a time to speak to you to talk it through in more detail. From myself and everyone else here at Kirk, I would like to thank everyone for their time this evening. Hopefully everyone found it a useful session. And we look forward to welcoming you to further webinars in the future. Thank you to my hosts as well for the evening, and we wish you all a good evening. Thank you very much.
Thank you.